I'm going to record. Okay. So the other day we talked about the Forex market. What is it all about? The importance or the benefits of trading the Forex market, the advantages that it has over other financial markets, and what you need to trade the Forex market, and when you have to trade and when not to trade. So today we are just going to refresh our minds back small on what we learned the other day. And after that, we'll continue with currency pairs. That's what we're going to learn for today. So let me start sharing my screen. All right. We said Forex market is about the exchange of currencies. These currencies are the currencies of foreign countries or different countries altogether. For instance, you have this thing, the American dollar, and want to exchange it for Naira or for Ghana cedis. You understand? Or when there is a transaction happening between two people in a different countries or different states altogether, they are participated in the Forex market. That's a Forex transaction. So simply means the exchange of currencies. That is the meaning of Forex. Forex, the exchange of foreign currencies or currencies with one another. You understand? So in the local Forex bureau market, we have where you can go and exchange your local currencies physically. For instance, you have a dollar and want to exchange it for Ghana cedi or for Naira. You can go there and do a physical transaction out there. But in the Forex market, as we are going to learn to see this thing, a software, this thing, a coded program where this thing, IT technicians have designed the trading software in such a way that you can also exchange one currency to another without doing it physically or without having it physical in your hands. So this means that we are going to be leveraging or benefiting from contract for differences, you understand? The differences that is between the exchange rate of these currencies is what we are going to be benefiting out of as a traders, you understand? So when you come to the Forex market, it's just simple. We buy and sell currencies in the Forex market. And how do we do that? We do it by simply having your trading platform with a broker. When you have your trading platform with any broker that can connect you in the financial market, you are free to go. You can trade the market peacefully. Understand? So what we're going to be doing is that we are going to learn about currency pairs today. Okay, the other day we said about Forex is the largest financial market in the world, but we have so many financial markets out there, and Forex happens to be the largest financial market in the world, which has a daily monetary or this a daily volume movement of about $6 trillion. Understand? And it is in the Forex market that whenever market is going down, you can make profit, and whenever market is going up, you can make profit again. There are other financial markets where you only make profit when market is pushing up. For instance, stocks. We only make profit in the stocks market when a company is gaining value or is appreciating in value. That's when you can make profits. But in the Forex market, whether the market is going down or up, whether bulls are in control of the market or the bears are in control of the market, you can equally make profits in the Forex market. And you don't need huge capital amount of money to start Forex market. You can start as little as $10, provided if you have the knowledge or if you have a broker that can give you that minimum deposit balance of $10, you can start trading comfortable at any place in your room or at any place that you want. If you only have a strong network connection with your smartphone or with your computer, you are with a good skills, you are good to go. So Forex doesn't need huge amount of money to start. You can start at any place that you want. And the trading sessions based on different aspects. We have the London market, we have the New York market, and we have the Asian market. You understand? So which means you can trade the Forex market 24/5. Why 24/5? Because the market opens on Sunday evening or Sunday night and closes on Friday evening. It means that within the working days, market doesn't close on the working days. Market traded what? All the time in the working days. You understand? So when it is weekdays, for instance, Monday to Friday, you can trade the market at any point in time. but it's good to know when to trade and when not to trade, because it's not all the hours that are equally having the same monetary movement or volatility in the market. So you must know which time or which hour for you to be in the forex market so that you can get good opportunity out of the market. You understand? So today we are going to be talking about currency pairs. As forex is just about the currencies, so we're going to be talking about currencies. As we all know, currencies are distinct, are things that they are values, monetary values, or they are monetary distinct indications. What we have been identified or what our country has been regarded as a medium of exchange as money. You understand? Each and every country has a currency that has a monetary value which they use to spend. You understand? So we have millions of currencies out there. So far as we have different states or different countries. You understand? So in the forex market where we are buying and selling currencies, or where we are leveraging on the differences between contracts for differences in the markets, it means that we can trade each and every currency that we want, provided if the currency is in the financial market or if it has much volatility or momentum in the market. You understand? So these currencies are the money or that we are spending in each and every country or on our countries. You understand? So we have major currencies, we have minor currencies, and we have exotic currencies. So these currencies have been grouped in according to the way it is performing in the financial market. And this performance has been determined by the economical status of each and every country, which means that if your country has a stable economy or if your country economy is doing well, your currency will be strong in the financial market or in the forex market. You understand? So based on these groupings, we have what we call the major currencies, we have the minor currencies, we also have what we call the exotics. You understand? So the major groupings are, I'm coming. The major currency groupings are the countries that are having stable economy in the world. And so as we all know, countries are stronger than countries are stronger than the other based on economical strength and power. You understand? There are some countries that have already developed, the like of US, China, America, and all those stuff. You understand? And we have a still developing countries like Ghana and Co. You understand? So when you come to the forex market or the financial market, the already developed nations are the nations that they have regarded as countries that have stable economy, which therefore their currencies in which they are spending is the major currencies that we have in the forex market. You understand? So when you come to the major aspect, we have a listed currencies or listed currencies that they believe that with these currencies or with these states, for them, they have a stable economy. You understand? Understand? So we have three types of currencies. Currency pairing. Okay, let's explain the pairing before. Currency pairs are the pairing or the combination of two currencies together. When we say pair, it means that something that is going in two, you understand? The pairing of two currencies against each other to determine which one is stronger than the other in a given period of time. That's what we call currency pairs in the forex market. It means that they are taking two currencies of different countries, matching it against each other to see which currency is very strong or which currency is stronger than the other at a given point in time or any point in the forex market, you understand? So based on this pairing, we have what you call major pairs. Major pairs are the pair of the strong, this in the currencies that are very strong in the financial market or the countries that have a stable economy. So when you take those countries and take their currencies and pair them against each other, to know which one is stronger than the other in terms of those states. That's what we call the major pairing. So with the majors, they take stronger currencies and pair them against each other. You understand? To know which one is stronger than the other. We call them the major pairing. You understand? And also have what we call minor currency pairs. With the minor currency pairs, it is the pairing against each other of these strong currencies that we're talking about. You understand? With the exception of US dollar. I don't know whether you guys are getting what I'm saying. So for instance, let me check, since I have image of major pairs here. Okay, you can see what I'm talking about. Major currency pairs, you understand? They have analyzed according to this in their according to experts, they have analyzed the market and they have seen that countries that are having stable economy are about 7. We have what? We have the US dollar, that's America. We have pounds, British pounds. We have Japanese yen. We have Swiss francs. We have Canadian dollar. We have Australian dollar. And we have what? New Zealand dollar. You understand? So these are the countries that they believe that they have a strong economy or a stable economy. So they have listed them as the major currencies. So when you pair these currencies against each other, to know which one is stronger than the other within a given period of time in the market, we call it what? A major pairing. So with the major pairing, we have euro paired against US dollar. It means that, coming, you can check something here. We have two currencies, euro slash USD. And we have base currency and we have quote currency. So when you see something like this, euro slash US, it means that they are pairing euro against US dollar to know which one is stronger than the other at any moment in the market. You understand? So if you see a pair like this in the forex market, it's not your duty or your responsibility as a trader to know which one is stronger than the other or which one will be stronger than the other at this moment in time or in future. Where will this currency be and where will this one be? And there are a lot of factors that affect this strength or knowing which one is stronger than the other in the market. We have economical events, we have political events, you understand, that affects the strength of a currency or things that we consider before betting on any currency. And we will still talk more about these things. So for instance, if you check this image you are seeing here, it means that they have paired euro against US dollar, which means that if you have euro and you want to exchange it for dollar, that's what they're just trying to tell you. If you have euro and you want to exchange euro for dollar, you understand? So whenever you see a currency quote like this, we call a currency quote or currency pair, you understand? You will see that the first currency, the currency that is coming first, that is what we call the base currency. And the currency in which that is coming last, the last currency is what we call the quote currency. You understand? So the reason why they are three distinct letter words are they are abbreviated. You understand? That abbreviation of the name of this thing, it is country and the symbol for the currency. You understand? So this is why euro and this is why US dollar. You understand? So the euro is the first currency, which is what the base currency. So whenever you see something like this on a currency code, know that the first currency is the base currency and the second currency is the quote currency. You understand? And what this thing simply means is that if you have one of the first currency and you want to exchange it for the base currency, the exchange rate will be there, or there will be an exchange rate for that. For instance, for example, maybe you have euro USD here. It means that 1 euro, if you want to exchange euro for USD, if there were to be, let's say, exchange rate was to be maybe 1.2580, 1.2580, it means that if you have 1 euro and you want to exchange it for US dollar, the exchange rate will be at 1.2580 at that moment. And it fluctuates. Currency exchange rate fluctuates. It doesn't stay at a fixed point. You understand? Each and every seconds, it changes. You understand? So it depends on the moment where you are analyzing it. You can analyze it to be 1.28, maybe 50, and in the next second, it will change. Fluctuations will happen, you understand? I don't know whether you guys are getting what I'm trying to explain.
Yes.
Okay, for instance, let's look at this example. You see that we have euro slash USD is equal to 1.35361. They are simply telling us that if you have 1 euro, which is the base currency, and you want to exchange it for dollar, for USD, which is the quote currency, it means that if you have 1 euro and you want to exchange it for dollar, you'll be getting 1.35361 in return. You understand? You understand? So it means that in order for you to buy or to have one of the first currency, 1 unit of the first currency, which is what, the euro, you must have 1.35361 US dollar in for that, to exchange for that. And how this thing work in the forex market is that whenever you have pair like this, euro USD, it can be any pair. It means that if you want to buy, it means that you are trusting the base currency. You have believed that the base currency is going to increase in value or appreciate in value. It's going to strengthen against the quote currency. In this scenario, it means that euro is going to strengthen against US dollar. So if we are betting on euro or if we are buying euro, it means that we believe euro is going to increase in value or appreciate in value, whilst USD depreciates in value. So whenever you are buying euro, you are releasing USD out. Why? Because we don't want it to depreciate in value whilst we are holding it. So it's a what? It's a simultaneous what? Exchange. Whenever you are buying one, you are selling one at the same time. Simultaneously, you understand? And whenever you are selling one, you are buying one at the same time. That's why they say exchange, foreign exchange. It means that you can't do single transaction. Whenever you are exchanging or you are buying, you are receiving at the same time. And whenever you are selling, you are giving out, you are receiving at the same time again. That's why it's called exchange. You give something and get something. So in this scenario, it means that if you have 1 euro and you want to exchange it for USD, you are going to have 1.35361 as US dollar before you can get 1 euro. And the same thing happens if you believe that the dollar is going to strengthen against the euro, which means the euro is going to depreciate in value due to other factors, come economical event or political instability in the country or political events, you understand? And you believe that it is going to strengthen against the euro, which means the euro is going to depreciate in value. You have to what? Sell the euro. So when you sell the euro, you are now buying the USD, which means you expect the exchange rate, which is 1.3561, to reduce. That's what you are telling this your broker or the forex market. You believe that the 1.35361 exchange rate will still reduce more, which means dollar is going to gain strong. This in value is going to be stronger than the euro. So at that point, you are going to release euro and hold dollar, which means you are going to sell. So the basis of selling and buying in the forex market happen based on the base currency. So whenever you are buying the base currency, expecting it to be stronger or to strengthen against the quote currency. And whenever you are selling the base currency, expecting the base currency to depreciate in value against the quote currency, which means you expect the quote currency in this scenario, which is US dollar, to strengthen against the euro. That's why you are selling euro and you are holding dollar. So when you are selling euro, you are receiving dollar. That's how it operates in the forex market. I don't know whether you guys are with me.
Yes, sir, we are with you.
Yes. Yes. Yes.
Okay, then you mute your mic and continue. So we have come to the minor pairs. We have explained major pairs and we're not explaining minor pairs. You understand? So with minor pairs, it is the pairing of these major currencies or the stronger currencies that we've mentioned already against each other, with the exception of US dollar. Which means if you get any of these strong currencies that we've mentioned, the euro, the pounds, the AUD, which is Australian dollar, the Canadian dollar, and the New Zealand dollar, and the Swiss, that's Swiss francs, you understand? If you get any of these currencies being paired against each other in the forex market, with the exception of USD, it's called what? A minor pair. That's what the minus, the pair of these 7 currencies against each other, with the exception of USD. I don't know whether you guys are getting it. Understand? So we have exotic pairs. With the issue of exotic pairs are the pairing of exotics are the pairing of the strong currencies that we have mentioned already against the still growing countries' currency. Countries that are still developing, that doesn't have a stable economy, and they are still developing, they are still growing up, you understand, in terms of economically these things. So these countries have regarded as what? Exotics. The pairing of these currencies against each other we call what? Exotics. Which means you can get, for instance, US dollar paired against South African rands, or US dollar paired against Ghana cedis, or US dollar paired against Naira, or any of the currencies, the strong nations' currencies paired against the weaker nations' currencies, the still growing economical currencies. We call what? Exotic pairs. So the way they have arranged it this way is that the major pairs are the pairs that are mostly traded in the forex market. Pairs that are mostly or almost traded each and every time in the forex market are the major pairs. They are countries that have stable economies. So investors easily trust those nations with their capitals or with their funds. So when they are investing into the currencies of these countries, they don't fear anything, you understand? So that's why they are regarded as the majors. Many people are looking up to those currencies, and there are a lot of trust on them, which means those who are betting on them are more in the market, are the majority in the market. So that is why it is what the mostly or popularly traded in the market. So if you are someone who is a beginner, in order to be safe in this market, it is good you stick to those major pairs. With the major pairs, market makers don't easily manipulate this space. So because of the larger trading volatility, it is the spread on those things are even very small as compared to some of the minors and the distant and the exotics. So I would recommend you guys to just stick to the major pairs and the minor pairs for now. Exotics are not that good to be traded. Why? Because there's less moment volatility on that. Less market participants are on the exotic pairs. So less are being traded out there, which has made you to have a huge spread or charges from your brokers. In order for you to make profit, you might even lose all your profit to your brokers in the process of trading this exotic pairs. So as a beginner, you will stick to major pairs and minor pairs. You understand? Are we together? So when you check this example,
Yes, we are together.
you will see that what I was explaining, the Euro/USD, you will see sell and buy. And when you will see base currency and quote currency. So if you check very well, you will see that on the base currency aspect, the box, they have said selling euro and buying US dollar. It means that if you want to sell euro, you are buying US dollar in return. And when you want to buy euro, you are selling US dollar out. It means that you already have dollar and you are releasing it out. So that's how this currency pairs works. When they pair two currencies against each other, they want you to know which one will be stronger than the other in the next minute or in the next hour as a trader. So if you're able to determine or to predict which one is stronger or which one will be stronger than the other in the next hour or in the next minute, that's when you will make your profit in the market. So that's how forex traders make their profits. So let's take this, for instance. For instance, if we are going to take Euro USD, we have Euro/USD, which is equal to 1.35361. So if we are going to bet our money on Euro, and we believe that Euro is going to gain value or appreciate in value, it is going to rise or strengthen against dollar. It means that we expect the current exchange rate of Euro USD, which is 1.35361, to increase, to rise up more than the current figure, the current exchange rate. So if we put buys on euro And it actually happens that the exchange rate, which is 1.35361, has increased to maybe, for instance, 1.3538. It means that there's an increment of what? Two movements from 36 to 30. That's two, you understand? So we have that two that we have seen is our profit. So in the Forex market, we call it what? Pips movement. We'll still come to that. Pips movement. So it means that there's an increment of 2 pips in price. So this is what will give us money or profit in the market when we bet our money on euro against US dollar. Or if we say in the next minute, the exchange rate of euro USD is going to be 1.3540. It means that there's an increment of 4 pips in addition to that. So the 4 pips or the 4-point movement is our profit in the market. For instance, if we want to sell euro against USD, like this pair, euro against US dollar, it means that we are expecting US dollar to gain more value or to strengthen against euro, which means US dollar is going to perform more than the euro. So it means that the exchange rate, which is 1.3536, it has to reduce. Why? Because the euro has fallen in value, it has depreciated in value, which means the strength that it was carrying and the exchange was 1.3530 is no more there. So we should expect it to reduce from 1.35 to any number, you understand? So for instance, if it has been reduced to what? 1.3534, it means that there's a decrement or decrease in 2 pip movement from 36 now to 34, which means the euro has depreciated in value. So the dollar has increased in value against the euro. So if we were to take any action, it means that we were going to sell the euro against the dollar, so that the dollar will increase in value and will benefit out of that. You can now ask your questions. I'm done with the presentation now. We are left with 5 minutes, so use that 5 minutes to ask your questions, and we'll call it a day.